Hello guys, let's learn about ratio analysis today. Financial ratio analysis. What are these financial ratio analysis? It is a financial metric and a beautiful tool to assess an organization's financial health. Let's take an example. So let's assume you are an XYZ corporation and would like to borrow $50,000 from a bank. Okay? You approach a bank and request them to lend money for your business, which may be dealing with ID, manufacturing, or insurance, whatever it may be. Do you think banks are going to lend you money without knowing how well you're performing in the market, or without knowing your financial status, financial position, or performance? Are they going to lend you money? No, they are not going to lend you money without knowing all these metrics. Now imagine you are an investor and would like to invest in XYZ Corporation. Are you going to invest without knowing their financial performance, position, or their financial status? Ultimately, you want to get your invested money with some profits in the future. You basically invest to grow your capital. So you're not going to blindly invest without knowing all these details. And now imagine you are a creditor or a supplier who wants to lend money or supply your goods or services to XYZ Corporation. Are you going to lend or supply goods or services without knowing their financial health? No, you're not going to do that. You want to know basically, are they liquid enough to pay all the short term obligations or long term obligations as they come due? Ultimately, for example, you don't want to invest in an organization or lend credit to an organization where they use long term assets to liquidate their short term obligation. You will know that, the moment you get to know about it, you will think the organization is not performing that well. So you want to know are they liquid enough to settle or retire their short-term obligation with their short-term assets like cash or inventory or accounts receivable, etc. To assess all these details, ratio analysis helps to assess an organization financial health. And where are they going to refer all these details? They're going to refer all these details by looking at their financial statement. It may be using income statement or the balance sheet or their statement of cash flows or combination of uh, any two statements or all the three statements. It depends. Usually, investors, creditors, suppliers, or bankers, etc., employ ratio analysis to assess an organization's financial health, whether to invest, lend money, or credit. It can be done by studying its past and present financial statement. Thus, ratio analysis helps to compare each line item of financial statements to reveal insight into its profitability, liquidity, operational efficiency, and solvency position. Ratio analysis can help to assess how an organization is performing over a period of time while comparing its performance to another organization within the same industry or with other sectors, or with the same organization within different periods of time. We can say ratios can be classified into four groups. Classification of ratios based on liquidity. You can check whether an organization is liquid enough to pay their short-term obligations as they come due. Or you can classify ratios based on its activity measures. Or you can classify ratios based on its solvency position, whether they are solvent enough to survive in the long run. Or you can classify ratio based on its leverage. Let's study about each of these classification and different metrics in our next video. Thank you so much.